Okay, guys, so this is another short video on the Fibonacci tool. What is the Fibonacci tool and how to use the Fibonacci tool in the markets? Okay, so in front of us, we have an example of the Fibonacci retracement tool. You get access to this by using the third option on the left here. You click the arrow and then you select Fib retracement and you draw it out just like this. Okay, so the Fibonacci tool is used to identify potential support in an uptrending market and potential resistance in a downtrending market. The support and resistance areas that this tool identifies are used to predict pullbacks in the market to help us identify now where the market can reverse and continue in the direction of the overall trend. Okay, so let's go down a bit here now. So we have two scenarios. We have on the left side, we have a uptrending market, and on the right side, we have a downtrending market. So now let's use the Fibonacci tool so we could see how useful it is. So you start off by using the tool by drawing at the swing low, which is the bottom here, to the swing high, which is this high up here. Okay, let's pull it out a little bit. And you will see that price made a pullback. So we had price pushing to the upside. Then we had a pullback or a bullish counter trend all the way to the 38.2% level. And then we had price pushing now all the way to the negative 27%. I'll explain the importance of these percentages shortly. Okay, so now we could deal with this. So you see how it helped us to identify where the support was and where we could look to take profits. So now let's draw the Fibonacci tool on this area here. All right, so this was the swing low and this is the swing high. We had a 61.8 retracement on this move here. So support was confirmed at the 61.8 level on the Fibonacci, and then we had price pushing all the way to the 36 negative 61.8%, which is also a TP area. So the tool helps us to identify again support areas in an uptrending market and where we could also look to take profits. So now let's try this on a downtrending market now. So we pull the tool from the swing high in a downtrending market to the swing low. All right. Now, as you can see, price was pushing to the downside. Then we had the bullish counter trend all the way to the 61.8 price reversal zone. Then we have price now continuing in the direction of the overall bearish trend all the way to the negative 27%, which is, as I said, the area on the fib that helps us identify where to take profits in the market. It sets targets for us. All right, so now let me explain the importance of these numbers to you guys. So again, we have three scenarios here now. So the fib levels that I have mapped out here is only really three levels. And I'll explain why it's only three and why these three are the most important. So the 23.6% fib level, when price retraces to this area, you usually have a form of consolidation or price range before price then continues to the direction of the overall trend, which in this case was bullish, so it continued to the upside. All right, but when price retraces to the 23.6 area, it is not steep enough to be considered a real high low. All right, so we don't usually look at it as an area for high probability entries, but as I said, it's good to know what the purpose of the 23.6 area is for. We usually have a consolidation or price range if price comes down into that area. All right, so now in the second scenario, we have price coming into the 38.2 area. So we started off at the low, bullish momentum to the upside. We had the bearish counter trend all the way into the 38.2 area where price reversed now This is also where you can expect a first real high low because this is steep enough to be considered a retracement. So the 38.2 area is where you would consider the first real high low because it is steep enough. So when price comes into this area, you would usually expect a sharp push now all the way to the TP area. And now in the third scenario, we have price again, bullish trend, swing low, swing high. We had a retracement to the 61.8 area. Now this is considered a steep retracement, but these are the areas that are most important to look out for when you want to get into the market. When you see a trade opportunity forming and you want to get into the market, you want to get in when price retraces to either the 38.2 or the 61.8. These are the most important high probability price reversal zones on the Fibonacci tool. Okay, so when I get a retracement to the 61.8, you could expect price to move slow and steady, but it will more than likely have a higher probability of pushing in the direction of the overall trend regardless. It will just be a bit slow and steady, but that could work out in your advantage if you are a scalper, for example, because you could take advantage of the multiple opportunities that the market is going to form while forming so much higher lows. All right, so now on the Fibonacci tool, I know you probably noticed these numbers in blue up here also. These are the These are called Fib extension levels, which are also the areas that we look for, if you may notice, to take TPs or with what we would consider price targets. All right, so the negative 23.6, the negative 27%, sorry, is our first TP area where you could look to take partials or do a full close. And the negative 61.8 is our second TP area. So usually when we get a retracement at one of these levels on the Fibonacci, we would usually expect price to push towards one of these areas in the market. So this is also a good way to set TPs, especially like when you're now starting, for example, it's a good way to help you like figure out, okay, this my TP will be here, my entry will be here, my stop loss will be here. Oh, and I also forgot to mention the stop loss aspect of the Fib. So in the first example here, you would see two extra numbers. This would be 0.00, which would be the swing high. I just took them out from my Fibonacci because I don't use them as reversal zones, but just for the sake of the example, you have the swing high at the 0.00 level and the swing low at the 100% level. And this is in red because this would be your stop loss also. So when you're drawing these on the charts, you can also use this as your stop loss because once price breaks below here, for example, it will definitely be a breakout structure and you would not want to be in that position anymore. All right, so very quickly, let's just draw two examples on the chart. All right, so we start off a downtrending market here, so let's use this example. We have the swing high here. You pull the tool from the top of the first bearish wick to the bottom of the bearish momentum here. Okay, and we spread it out. So we had a retracement to the 38.2. And then we had bearish momentum pushing all the way down to this was a very far TP level also, to the negative 161.8. This would be considered your TP3 level. As you can see, this is very far. So very high expectation TP. So we don't really use it that much, but depending on the time frame, you can use it. Okay, so we had the retracement here, we had the TP here, and now what we do is we draw our new Fibonacci. This would be our new swing high, and this would be our new swing low. All right, so The swing low was where price established support first, which was here, because we had a bearish candle followed by a bullish candle. Then we had a retracement into the 38.2 area. All right, when price had the bullish counter trend into this area, we had a lower high forming. That means the beginning of the bearish momentum continuing with the overall bearish trend all the way to the negative 27%, even as far as the negative 61.8%. Okay, so I hope this video helps you guys understand how to use the Fibonacci tool, how to set take profits, set targets, and also how to use it as a stop loss option. Okay, so see you guys in the next video.